Hello friends, welcome to my channel FinTech Logics. So today we will talk about a new digitization in case of lending, that is called as dynamic pricing for the loans. Now this is valid in case of any loans. That means the pricing has to be done on any loan. So pricing is simply setting up the interest rate on a loan. Now as we know, an interest rate would have a lot of components. It would have a base component, plus we would add a spread for profit and for risk mitigation. So in total, your interest rate that is referred from your normal prime lending rate, your cost of funds plus your spread makes it interest rate. So the process of calculating an interest rate for a loan is called as pricing. Now previous to this, the underwriters, while doing the underwriting of a loan, they used to take into account all these aspects and assign or calculate manually an interest rate that was given for the loan that they have underwritten. But gone are those days. Now there has been engines or models which actually create or calculate your interest rate on a dynamic basis. So this is called as dynamic pricing. Now with the modern age digitization, the scope of dynamic pricing has also evolved. That means for same type of loan, depending on the market situation and the customer type, different kinds of rates can be assigned, right? So we will learn about how does this happen actually in a normal loan scenario that we do a dynamic pricing using automated engines. So let's look at the description today. Now we have already talked about the entire loan life cycle, specifically originations and underwriting process. If you have not seen that, I'll try to provide some of the links. Please have a look. Now without wasting time, let's begin the topic of our discussion today. Now in simple words, digitization is helping to compute loan interest rate automatically, that considers different factors as we talked about, and with the help of an algorithm, computer algorithm, the pricing is calculated automatically. So this is the process of dynamic pricing. Now for doing that, let's look at 4 different types of parameters. So what is your factors for that? What is your pricing engine? What types of pricing engine can be there? What is the benefit? And what are the challenges for a dynamic pricing engine? So first, let's look at factors. So as we talked, for calculating this pricing, we would need different types of parameters. So what kind of parameters it would be? The first one would be the borrower profile. What kind of borrower I'm giving the loan to, right? How risky the borrower is, or probably how affluent the borrower is to pay my loans, which area the borrower stays, that I can, if it is in blacklisted area or not, right? So all of these parameters come into your borrower profile. So I would need a lot of parameters regarding borrower for doing this dynamic pricing. Now the second thing is cost and liability factors. So this takes into account the cost of funds for the lender. So suppose the lender is giving the loan of, let's say, 5,000 rupees. Now how is this 5,000 fetched? By either taking deposits or by borrowing from some other lenders with some specific rates. Now this cost and liability factors at that point of time also plays a major role in deciding the pricing. The third thing is about industry and market variables. So at certain point of time, while calculating this pricing, how is the scenario? Is the economic scenario good or bad? Is there, let's say I'm giving loan to MSME sector, is there a raw material crisis which is going on? Is there a demand crisis which is going on? So based on that also decision is made on pricing. And the last but not the least is risk related parameters, that okay, looking at all the micro and macroeconomic factors, what is the overall risk that I'm taking, I as a lender taking. So as per that also some parameters are introduced to calculate your pricing. Now as we have taken these or collected these variables, let's move to the next bucket, which is pricing engine. Now for pricing engine, there are three different types of pricing engine or models which are used to calculate pricing correctly. So the first one is cost plus loan pricing model. So this model actually takes into account very minimal parameters, like what is the cost of fund at that point of time, and based on that how a spread can be added by some certain rules that would decide my pricing. This is very simple, which is cost plus pricing model. Now the next one brings little more complexity in terms of making it market driven, so which is called as price leadership loan pricing. So in this model we look at additional factors like what is the pricing or what is the interest rate that is offered by my competitors, because if a certain lender would provide unnecessary higher cost, increasing the cost or profit margin, then there are chances that the lender would lose the borrower, lose the customer, right? So this takes into account the different competitors interest rate as well for similar type of loans. This is a market data, we get it, and then it can be used for deciding the pricing. The third one is risk based loan pricing, so wherein we take into account all the factors which are your micro and macroeconomic factors, certain risk of the borrower, specific borrower, and then decide about the pricing. So if you look at the pricing digitization at this point of time using technology, it has become a hybrid of all these three different approaches to actually derive your pricing at a much more accurate rate. So this is the pricing engine that works behind the scene to calculate your interest rate. Now what is the benefit of this dynamic pricing, right? So first one is actually reduction in your cost and turnaround time. So if all this calculation has to be done manually, definitely you would need lot more underwriters, what is being done by the pricing engines at this point of time. And because this is done in milliseconds, your turnaround time for underwriting also goes down. So that is why this becomes helpful in reducing your cost and your turnaround time for your origination. The next one is efficient risk return trade-off. Now because of multiple factors being considered, because of the speed with which it works, because of which the standardization that it brings, that makes your risk return trade-off a lot more predictable, that okay, for these types of loans under similar parameters your interest rate should be similar. So we are less error prone to the manual errors being made by underwriter, and this should be a lot more standardized process, and this will bring a lot of risk return trade-off as well. The third one is better customer value creation. So if a certain customer is much more credit worthy than another customer of similar financial, let's say, background, then we are actually offering a lower interest rate, and this brings a lot of value for the borrowers, that okay, they are not getting cheated by the lenders, and they are being underwritten in an appropriate manner to offer them a good interest rate or good pricing. The fourth one is increases the conversion. Now, using the pricing, because the turnaround time of your pricing can be reduced, a lot more offers can be generated and provided to the borrower for borrower to make a choice. So that increases your conversions as well, if you have this digitized dynamic pricing models being implemented perfectly for the loans. Now, at the same time, we should not be forgetting about the challenges. Now, we are talking about a lot of lenders here, right? So if you look at the model to be efficient in calculating a near perfect pricing, it has to go through a long model building process and a testing process as well. So a lot of times we see that okay, new lenders would struggle with the dynamic pricing model and end up giving a manual interest rate to their borrowers, because this needs a long process of making your engine work seamlessly with efficacy and all, right? So this is definitely a challenge to achieve a dynamic pricing model. Now, the next challenge is to match the speed of product innovation. So now all of us know that there is a lot of product innovation as in financial product, your loan product innovation, which goes on in this market with digitization. So gone are those days where there was just one personal loan. So there has been now loans specifically to meet every purpose and the payment capacity of the borrowers. So that is why a lot of product innovation is happening, but that also needs that our pricing engine should be able to match those innovation speed, and that becomes a challenge at certain point of time. Now, having told about all this thing, a faster implementation need is also required to make the pricing engine work seamlessly, changes brought together, compliances brought together immediately with regulatory norms coming up so frequently. So implementation has to be done on a very stringent timelines as well. So these, in short, sometimes create issues for the dynamic pricing model or engine to work efficiently, right? But definitely with your tech innovation, this is expanding, this is getting better in a faster way, and we are going towards better and better pricing engines day by day. So this is, in short, a very critical component of a loan underwriting, and digitization is helping it a lot in terms of building your models, taking help of data to even fine-tune your models, and even creating better value for the customer. So this is, in short, the dynamic pricing digitization. If you want to know more about the pricing engine variations like your cost, price leadership, and risk-based loan pricing, please let me know in the comments. I'll create individual videos for these models. Thanks a lot for watching my video, viewers. If you like my content, please consider subscribing to my channel. Thank you.